In this chapter, we will cover the 7 parts in completing the audit. By the end of this chapter, you should be able to do the following. You should be able to design and perform audit tests related to presentation and disclosure audit objectives. Conduct a review for contingent liabilities and commitments. Obtain and evaluate letters from the client's attorneys. Conduct a post-balance sheet review for subsequent events. Design and perform the final steps in the evidence accumulation segment of the audit. In addition, you should be able to integrate the audit evidence gathered and evaluate the overall audit results. Communicate effectively with the audit committee and management. And lastly, identify the auditor's responsibilities when facts affecting the audit report are discovered after its issuance. We will begin by designing and performing audit tests related to the presentation and disclosure audit objectives. As part of Phase 4 of the audit, auditors evaluate evidence they obtain during the first 3 phases of the audit and perform additional procedures for the presentation and disclosure-related objectives. One of the auditor's primary concerns related to presentation and disclosure is determining whether management has disclosed all required information. On the next slide, we will cover conducting a review for contingent liabilities and commitments. 3 conditions are required for a contingent liability to exist. The first condition is where there is a potential future payment to an outside party or the impairment of an asset that resulted from an existing condition. The second condition is if there is uncertainty about the amount of the future payment or impairment. And lastly, the outcome will be resolved by some future event or events. Auditors are especially concerned about certain pending liabilities such as a pending litigation for patent infringement, a product liability or other actions, an income tax dispute, a product warranty, notes receivable discounted, guarantees of obligation of others, and unused balances of outstanding letters of credit. Auditors' primary objectives in verifying contingent liabilities is to evaluate the accounting treatment of known contingent liabilities to determine whether management has properly classified the contingency, and to identify to the extent practical any contingencies not already identified by management. Audit procedures for finding contingencies involve the following: inquiring of management about the possibility of unrecorded contingencies, reviewing current and previous year's Internal Revenue Agent reports for income tax settlements, reviewing the minutes of directors and stockholders meetings for indications of litigation or other contingencies, analyzing legal expense for the period under audit for indications of contingent liabilities, especially lawsuits and pending tax assessments, obtaining a letter from each major attorney performing legal services for the client as to the status of pending litigation or other contingent liabilities, reviewing audit documentation for any information that may indicate a potential contingency, and examining letters of credit in force as of the balance sheet date, as well as obtaining a confirmation of the used and unused balances. Closely related to contingencies are commitments, which are agreements to commit the firm to a set of fixed conditions in the future, regardless of what happens to profits or the economy as a whole. If auditors conclude that there are contingent liabilities, auditors must evaluate the significance of the potential liability and the nature of the disclosure needed in the financial statements. Certified public accountants often obtain a separate evaluation of the potential liability from its own legal counsel, especially high material ones, rather than relying on management or management's attorneys. The search for unknown commitments is usually performed as part of the test in each audit area. The auditor should also be aware of the possibility of commitments when reading the minutes, contracts, and correspondence files of the client. Moving on, we will now discuss obtaining and evaluating letters from the client's attorneys. A procedure auditors rely on for evaluating known litigation and other claims and identifying new claims against the client is the inquiry of the client's attorneys. An example of a typical letter sent to the client's attorney for return directly to the CPA's office is shown in Figure 24-2 on page 772 of your textbook. If an attorney refuses to provide the auditor with information about material existing lawsuits or unasserted claims regarding the client, auditors must modify their audit report to reflect the lack of available evidence. The Sarbanes-Oxley Act requires attorneys serving public companies to report material violations of federal securities laws committed by the company. On the next slide, we will cover conducting a post-balance sheet review for subsequent events. The third part of completing the audit is the review for subsequent events. The auditor's responsibility for reviewing subsequent events is normally limited to the period beginning on the balance sheet date and ending with the date of the auditor's report. The period covered by subsequent events review and the timing of that review are shown in Figure 24-3 on page 774 of your textbook. Two types of subsequent events require consideration by management and an evaluation by the auditor. The first type is a subsequent event that has a direct effect on the financial statements and require adjustment on the side of the client. And the second type is one that does not have a direct effect on the financial statements, but for which disclosure may be required from the client. Examples of those that require adjustment are the declaration of bankruptcy by a customer with an outstanding accounts receivable balance, a settlement of litigation at an amount different from the amount recorded on the client's books, and the disposal of equipment not being used in operation at a price below the current book value. Examples of subsequent events for which disclosure may be required are a decline in the market value of securities held for temporary investment or resale, the issuance of bonds or equity securities, a decline in the market value of inventory as a consequence of government action barring further sale of a product, the uninsured loss of inventories as a result of fire, and lastly, a merger or acquisition. Auditors of accelerated filers may also identify events related to internal control over financial reporting that arose subsequent to year-end. There are two categories of audit procedures for the subsequent events review. The first category is one where procedures are normally integrated as part of the verification of year-end account balances, and the second category is procedures performed specifically for the purpose of discovering events or transactions that must be recognized as a subsequent event. The first category usually includes a cutoff and valuation test done as part of the test of details of balances. The second category are performed specifically to obtain information to incorporate into the current year's account balances or footnotes as test of the completeness, presentation, and disclosure objective. These include the review of records prepared subsequent to the balance sheet date, the review of internal statements prepared subsequent to the balance sheet date, the examination of the minutes issued subsequent to the balance sheet date, correspondence with the client's attorneys, inquiry of management, and lastly, obtaining a letter of representation. The letter of representation is a mandatory or required part of the audit specified in the auditing standards. Occasionally, the auditor determines that a subsequent event that affects current period financial statements occurred after the date of the audit report but before the audit report was issued. In that kind of situation, auditing standards require the auditor to extend audit tests for the newly discovered subsequent event. The auditor has two equally acceptable options for doing so. The first option is for the auditor to expand all subsequent event tests to the new date. With this option, the auditor simply changes the report date to the new date, or the auditor will restrict the subsequent event reviews to matters related to the new subsequent event. With this option, the auditor will issue a dual date audit report. Moving on, we will now discuss designing and performing the final steps in the evidence accumulation segment of the audit. Auditing standards require auditors to perform analytical procedures during the completion of the audit. It is common for a partner in a certified public accounting firm to do analytical procedures during the final review of the audit documentation. Results from final review may indicate that additional audit evidence is necessary. If any unexpected relationship is found due to client misstatement, the auditor should propose an adjustment if the misstatement is material. Auditing standards require the auditor to evaluate whether there is a substantial doubt about a client's ability to continue as a going concern at least 1 year beyond the balance sheet date. Auditors use analytical procedures, discussions with management, and their knowledge of the client's business to assess the likelihood of financial failure within 1 year. A final assessment of the entity's going concern status is desirable after all evidence has been accumulated and proposed audit adjustments have been incorporated into the financial statements. Auditing standards require the auditor to obtain written representations from management, usually in a letter of representation documenting management's most important oral representations made during the audit. This letter is prepared on the client's letterhead, addressed to the certified public accountant, and signed by the client's high-level corporate officials. The letter should be dated no earlier than the date of the auditor's report to ensure that there are adequate representations about subsequent events. The three purposes of the client letter of representation are to impress upon management its responsibilities for the assertions in the financial statements, to remind management of potential misstatements or omissions on the financial statements, and to document the responses from management to inquiries about various aspects of the audit. Auditing standards suggest 4 categories of specific matters that should be included. These categories are the financial statements, the completeness of information, recognition, measurement and disclosure, and lastly, subsequent events. Public Company Accounting Oversight Board auditing standards require the auditor to also obtain written representation from management regarding internal control over financial reporting. Clients often include additional information beyond the basic financial statements. The basic financial statements and additional supplementary information are illustrated in Figure 24-4 on page 780 of your textbook. Auditors must clearly distinguish their audit and reporting responsibility for the primary financial statements and for supplementary information. Auditing standards require the auditor to read other information included in the annual report pertaining directly to the financial statements. Auditor responsibility to read other information included in annual reporting pertains only to information that is not part of the financial statements but is published with them. If the auditor concludes that a material inconsistency exists, the auditor should request the client to change the information. If the client refuses, the auditor should include an explanatory paragraph in the auditor's audit report or withdraw from the engagement. In the next slide, we will discuss integrating the audit evidence gathered and evaluate the audit results. To make a final evaluation as to whether sufficient appropriate evidence has been accumulated, the auditor reviews the audit documentation for the entire audit to determine whether all material classes of transactions, accounts, and disclosures have been adequately tested. Auditors often use a completing the audit checklist, which is a reminder of items that may have been overlooked during the audit. A partial completing the audit checklist is shown in Figure 24-5 on page 782 of your textbook. An essential part of evaluating whether the financial statements are fairly stated involves the auditor's review of the summary of misstatements found in the audit. In addition to known misstatements, the auditor must consider possible misstatements as well. Both known and projected misstatements are shown in Figure 24-6 on page 783 of your textbook. Before completing the audit, auditors must make a final evaluation of whether the disclosures in the financial statements satisfy all presentation and disclosure objectives. A partial financial statement disclosure checklist is shown in Figure 24-7 of your textbook. There are 3 reasons why an experienced member of the audit firm must thoroughly review audit documentation at the completion of the audit. The first reason is to evaluate the performance of inexperienced personnel, to make sure that the audit meets the certified public accounting firm's standard of performance, to counteract the bias that often enters into the auditor's judgment. Except for final independent review, the review of audit documentation should be conducted by someone who is knowledgeable about the client and the circumstances of the audit. At the completion of larger audits, it is common to have the financial statements and the entire set of audit files reviewed by a completely independent reviewer who has not participated in the audit. An engagement quality review is required for SEC engagements, including the review of interim financial information and the audit of internal controls. The reviewer often takes an adversarial position to make sure the audit was adequate, evaluating whether there is sufficient appropriate evidence and whether evidence supports the opinion on the financial statement is summarized in Figure 24-8 of your textbook. The auditor should wait to decide the appropriate audit report to issue until all evidence has been accumulated and evaluated, including all steps of completing the audit. Most certified public accounting firms have comprehensive audit reporting manuals to assist them in selecting the appropriate wording of the report they decide to issue. In the next slide, we will discuss communicating effectively with the audit committee and management. Auditing standards require the auditor to communicate in writing all fraud and illegal acts to the audit committee or its equivalent, regardless of materiality. The auditor must communicate in writing significant internal control deficiencies and material weaknesses in the design or operation of internal control to those charged with governance. Auditing standards require the auditor to communicate certain additional information to those charged with governance. There are four principal purposes of these required communications. The first purpose is to communicate auditor responsibilities in the audit of financial statements. Second, to provide an overview of the scope and timing of the audit. Third, to provide those charged with governance with significant findings arising during the audit. And fourth, to obtain from those charged with governance information relevant to the audit. The Sarbanes-Oxley Act requires additional communications for auditors of public companies. As the audit is completed, the auditor should determine that the audit committee is informed about the initial selections of and any changes in significant accounting policies. A management letter is intended to inform the client personnel of the certified public accountant's recommendations for improving any part of the client's business. Moving on, we will now cover identifying the auditor's responsibilities when facts affecting the audit report are discovered after its issuance. Although it is rare, auditors sometimes learn after the audited financial statements have been issued that the financial statements are materially misstated. When this subsequent discovery of facts occurs, the auditor has an obligation to make certain that users who are relying on the financial statements are informed about the misstatements or the change in the conclusion of the effectiveness of internal controls. If the auditor discovers that the statements are misleading after they have been issued, the most desirable action is to request that the client issue an immediate revision of the financial statement that includes an explanation of the reason for the revision. The timeline for subsequent discovery of facts is shown in Figure 24-9 on page 788 of your textbook. Please complete the required evaluation method for Chapter 24 as it will be part of your final grade. Use Blackboard to complete the requirements. You have reached the end of the course presentation for Chapter 24.